Good morning. I'm Larry Morgan, Senior Account Executive at Archer Daniels Services, and I'm here to make some comment on the financial markets, interest rates, and currencies. This morning, the focus is primarily on stocks, actually. As you may know, they began to drop pretty quickly yesterday at midday. They'd been treading water for several days. And then around 12 o'clock Eastern Time yesterday, they began to drop quite suddenly. The immediate trigger was some remarks from the president of the Philadelphia Federal Reserve Bank, who expressed some doubts, more than doubts, about the current Federal Reserve policy. But I don't think that was the real cause of it. Much more basic to it was continuing, you could say, deteriorating developments in Europe. In particular, yesterday there were substantial street protests, they might even be riots, in Madrid over the austerity measures that the current government is instituting. So stocks fell fairly sharply in the United States yesterday afternoon, and they've continued down. Tokyo fell about 2%, Shanghai fell about 1.25%, and the European stock markets are down about 2%. The U.S. futures markets so far are not down that much, maybe 0.2%, but it still seems to be the consequence of the deterioration in Europe. And this is an interesting thing. For the previous couple of weeks, people had been, well, even euphoric about the developments in Europe. After the European Central Bank's new policy decision at the beginning of September, where they decided that they would buy the bonds of struggling European countries, Spain, France, Italy, Portugal, Ireland, to support those markets and keep interest rates in those countries from going up too high. This brought a real sense of, as I say, euphoria regarding the European situation. The market feeling that Europe was finally, after months and months, really coming to grips with its difficulties. But then nothing happened. There were no bond purchases. Remember, the bonds will only be purchased after a recipient country makes a request for it. Nobody's requested it yet. The focus has been on Spain, and Spain has been prevaricating about this. Yesterday, these demonstrations began. They were pretty extensive, maybe even somewhat violent. And as that news really got around, the stocks began to drop pretty sharply, and that's continued. This has also put a bid into the high-rated government bonds, U.S. Treasuries, German Bunds, British gilts. And they've continued to go up yesterday afternoon and overnight and now. This has also been helped, of course, by the current Fed policy, the QE plus, we might call it, by which they'll continue to buy bonds, particularly mortgage-backed securities. And the euro currency has fallen 3 weeks ago after the ECB meeting. That got up to about 130, 170. Since then, it's fallen back, especially in the last couple of days. This morning, it's at about 128.50. It's fallen about 3 cents. As doubts about Europe's ability to deal with its problems, to really come to grips with them, as those doubts continue, I would expect to see some continued weakness in equities, continued weakness in the euro, and continued strength in the high-quality government bonds, treasuries, and bunds. I do not expect that the stock markets are really going into a reversal. I think this is more of a retracement. The big problem there is going to come after the turn of the year with the so-called U.S. fiscal cliff and so on. But so far, the markets are not really reflecting that. So I'd look at this setback in at least U.S. stocks as a retracement, not as a reversal. I think in terms of December mini S&P futures contract, the area of about 1420 to 1430 is probably where it will settle and where people will start to buy again. For the euro, it's fallen to, as I say, to about 128.5. I think the neighborhood of 125 to 130 is probably its home base for the next some weeks. If anything, there's more risk to the downside there if the situation in Europe becomes still more confused. For the U.S. Treasuries, the general trend will continue to be a very, very mild upward trend. I would maintain a basic long position in that, reduce that long position on strength, such as possibly today, and then add back in again when there's a correction to the downside. That's my outlook for, let's say, the next 3 weeks in those markets. Once again, I want to point out that these opinions are entirely mine. They're not the opinions of Archer Financial Services. They're not the opinions of ADM Investor Services. Thank you.
The Fed really wants to be perceived as independent and doing the right thing each